Well, it depends how much capital is raised, I suppose. I think our view is that we will, in our fundraising activities, we'll look to raise, hopefully, a series of small funds. So, we'll raise a limited amount of money, and at the moment we're looking to raise around 300 million, which is quite a small fund for us. But because we're not sure that, the size of the opportunity is big enough to go and spend the billion. Clearly, we would hope that we'll spend the 300 million. Convince investors that it was a very good thing to do to give it to us, and they'll give us some more. So I think, given the total size of the problem in Europe, we kind of think there has to be enough opportunity there for some money to be successfully put to work. Is the opportunity big enough for the larger sort of the big loan buyers, for example? I mean, I could use an example, Lone Star. Is there a big enough opportunity coming for them to be able to gobble up the kind of size of loans that they traditionally have done? I don't know. I would say at the current pace, probably not, but to be seen.
What's your view on that, Matthew? What are you seeing from, because you're kind of seeing both sides to a certain extent.
I think it very much depends what corner of the market you're talking about. I think people that owns secondary property on short weighted average lease terms, I think would be delighted to talk to you about how to sell them. So I think it depends what corner of the market you talk about. I think at the prime end, as much as people talk about high pricing, the more we talk about it, the more reverse inquiry I'm getting about a number of people that want to buy a 100 million plus office building in the city. So I think that's certainly continuing. So it is very much a polarization. I think on the NPL side, to react to the point that was just made, one thing we haven't seen just yet in any big scale is pan-European portfolios coming to the market. I think in the UK, I tend to agree there's probably not enough in the draw to satisfy the pools of capital that have been raised. But the fundamentals are pretty much all the European banks are retracting to their core markets, and therefore where they had perhaps 10 subsidiaries across Europe, they have no intention to have 10 subsidiaries across Europe for very long. And that's probably where this capital will ultimately be deployed. Because if you're a German banker from a regional bank sitting in Hamburg, you're really wondering why you have a subsidiary in Madrid, and you're really wondering why you ended up having a 500 million loan book over there. It's a hassle. And I think over a period of time, as these institutions effectively come back to their core markets, I think that's where the Lone Star will probably look to fill their boots, as well as the more pan-European situations where I think it's really, really difficult. I can't remember who mentioned the architecture. Restructuring is difficult enough when you're doing it, when you have a team focused on a given market. Some of the CMBS situations we're seeing coming out, I've got 2 office buildings in the Netherlands, 1 in Belgium, 1 in Spain, and a retail park in Germany. Talking about, if we think what we've looked at before is complicated, this is going to get a lot more time consuming. And I think that's where I point people are now taking the benefit of their experience and say, you know what, I've already done some of these individually. I don't have the patience, nor the resources, nor the capital to keep that structure on my balance sheet. I'll let Lone Star do that, because the marginal cost of them doing it is probably a lot quicker, a lot lower, and that will probably outweigh the difference in cost of capital.